Hello, ladies and gentlemen, and welcome back. We need to talk about Santa Claus rallies. And of course, this is one of the big statistics that everybody's using in 2022 to try to justify the current rally that we're seeing. Has Santa actually come back to the markets, or is this all part of a larger trap towards pushing markets a little bit more negative in 2023? Well, today we discuss our thought process into 2023 for stocks, commodities, and crypto markets. And more importantly, we take a look at what this really means in terms of Santa Claus rallies, because as of next week, it technically should be beginning. If it goes bad, the stats might surprise you to how bad things get in 2023. Well, welcome back, everybody, to the Daily Show where we talk about markets around the world. We've got all the latest news, the macro data, and of course, the lead indicators for today's show. But just quickly, some breaking news stories that I think are important to the markets right now. Follow us at FX Evolution on Twitter if you're interested in finding out more. The first one is I noticed that Tesla in America have changed their tune. They're now offering, as of pickups to the December 31st, $7,500 off and 10K supercharging miles. Does that sound like stat padding to you? Well, go and get into the discussion over on our Twitter, see what you guys think. Let's begin, though, with Santa Claus rallies, because this is the big data stat that really matters in markets moving forward. Technically, if Santa doesn't come, bad things tend to happen in January, even the calendar year. Look at some of these big reds that we've had in the past around Santa Claus points. You'll also notice that, yes, the Santa Claus rally is clearly a statistical thing because there's way more greens than reds across the board. Now, when does it start? Theoretically, it starts as of the day after Christmas. You know, I don't really care. I usually think it starts somewhere around that kind of 20th to 16th of December, and we tend to see that rally through. But as of these dates, we're looking literally at the day after Christmas in the markets, all the way through to early January. So see, these are some of the worst Santa Claus rallies ever taken over the last 20 years since pretty much the tech boom. And we see here that, generally speaking, if we get a red run for these periods of time, it tends to leak through to the January, the quarter one, and sometimes the entire calendar year. Of course, most notably the global financial crisis and the tech bust. This year will be very important. We're going to be paying a lot of attention to it, and I think this is a stat that you must watch. So make sure to subscribe to the channel so we can follow along on that. So let's get into our thought process for 2023. So many people have been messaging us and talking in the community about what our expectations are. Well, we're not really going to change many things. We do think that the Federal Reserve will have to pivot in 2023. We also think that we could be in stagflation, which has been brought on by not only an increase in silver and gold, which are great stagflation asset classes, but also the Bank of Japan basically giving up on its anti-inflationary stance. They will most likely rate hike in 2023, and that will have some impacts on the market and more impacts on treasuries and other things that we'll talk about in subsequent videos. But what about earnings? What about what's going on? We think that valuations are going to be the big concern, and earnings, especially Q1 and Q2, will be in the headlights for stocks. And you can see here the percentage of S&P 500 companies with positive 3-month percentage change in forward earnings. It's not very good. It traditionally gets worse. These are the bear market years, and traditionally we usually see more drops before recoveries. This is a very interesting statistic. Let's now break it down to what's going on right now in terms of earnings per share. Again, there's more room for downside moving forward. Sorry to be the bearer of bad news, but if things go bad, these are things that we want to look at. Now, when we talk about valuations, a lot of people use PE. The problem with PE is if we use raw PE, we're not really going to be able to recognize times that we want to be buying in markets. It's probably better to use forward PE ratios in comparison. There are other metrics that we'll talk about in 2023 that we could be using. But at the moment, we're sitting around 17. And funnily enough, 17 times forward earnings is actually basically fair value for the market. So if valuations start to go down further, we expect the forward PE to track around 17. If we see something like a 14 PE, is that cheap? Well, arguably, that is a good deal. In fact, statistically, that would be where someone like Warren Buffett or somebody like that would be thinking, hey, there's value in this market. Maybe it's worth me getting greedy when others are fearful. So at this stage, coming into the back end of 2022, are we expensive or are we cheap? Well, ultimately, we're at fair value. Yes, that's actually where we're at coming into the earnings. And I wouldn't be surprised at all, especially if Santa doesn't come this year into 2023, for us to do a sell the rumor, that is sell into really bad earnings expectations and then potentially buy the bad earnings. Just a thought process there. Let's look at some of the stats, and we've got a great stat coming out in our weekend video, or maybe even the Friday video about this. Where first one is MACD. MACD made a switch from positive to negative. We also saw that with a declining 200-day moving average. We've got a few data points in the past from this, and we've already detailed many times that helped us to make the decision that the market was bearish about a week and a half ago. Now we move forward. Do we still think the market is in a kangaroo or bearish market? Most likely it is, but we do need to be wary of what happens next. So we know that in bear market years, the Santa Claus rally is muted. That is, it comes through, but it goes down and it kind of stays around. It's not like other ones. But more importantly, we also know that we're kind of coming back to what we could call the calm before the storm. The volatility index is back at 20. So as we look here and we scroll through, you'll notice that 20 is traditionally where we see markets switch from being bull markets underneath and bear markets above. Very important point, critical level heading into a very low options volume and generally low liquidity period of time, which is the Santa Claus period after, of course, Christmas. Let's move through and see what the market's telling us about this current rally. Bonds did come up. We have high yield bonds here looking okay. I mean, let's be frank, these are junk bonds. Do I like them? No, but we do use junk bonds to give us a bit of an understanding whether the market is rallying correctly or not. Recently, we used that to kind of detail the topping of the market, and it still looks like this island reversal here, similar to the other one, may have a rally through on it. But in the next 24 hours, what I would like to see, maybe the next 48 hours of market action, we generally like to see the market go up and high yield bonds come down. Can we get that kind of corresponding market? That's going to be a great warning sign that we have to believe that the rally is most likely false. What about yields? Well, not much change on the yields. We saw a little bit of a drop in the last 24 hours, which can be easily correlated to why we believe the markets have gone up. Forward yields didn't really change. We're still looking at around 4.8% here from April, March in 2023. That's where we expect rates to peak off. And then we're expecting cuts, as many as potentially 2 cuts now coming into the back end of 2023. The only reason the Federal Reserve will cut is because the economy is looking weak. Again, earnings are going to show us this. Probably unemployment is going to rise. These are all things that we now know are very likely to occur in the markets in 2023. Let's now move over to the US dollar. How's it looking? Well, shaky, but it did break through that 104. So does that mean that the market can now rally in terms of US dollars? It's right around the zone that you would expect the market now to find some buyers. So it's kind of now or never for DXY in the short term. It really needs to find a rally here and around this price, and then ideally we would move through. What about the evidence that we had in the previous kind of day of trade? Well, we got this really nice bullish style wick candle. That was good. We obviously came down to the base. That was good. We made the sequence before that, which was technically good. So it's time now for the DXY to really put in some work if it's going to. The traditional trend right now is, of course, down. We do think the dollar is not going to be anywhere near as strong as it was in 2022. This was the breakout trade in 2022. Don't expect 23 to be the year of the US dollar. It's going to be probably the year of other currencies, and that may go against what you're thinking, but again, we'll explain that in a subsequent video. It's a bit bigger topic for today. Let's move over to gold. So how's gold faring? Well, with the dollar trying its best to find some form of strength, gold is hanging on by a thread, not breaking through. If anyone's been watching silver's been absolutely skyrocketing again the last 24 hours. But the thing with gold is it theoretically should have shorted off this area. It didn't do so. So because of that, because of what the Bank of Japan's done, because of people's concerns over currencies in the world and economic policy, I think gold's finding a little bit more strength. We are bullish gold medium term, that is 3 to 6 months, and we think that it will do well over that period. If I was having to guess, I'd still go with, the potential of it shorting off here, but it's a 50-50 guess really at this point. Over here would have been more bearish, and technically the stops would be holding for now. Let's find out whether the DXY can find the strength. It's a tough one. Now, US oil is where we had our suspicions. So we were certainly negative on oil here. The downward trend line was so overpowering, and it did sell off. Here's the problem, though. It didn't keep going. Every time it rallied, especially this one here, it didn't make a new low. See that big wick? It didn't sell off. Then we got this annoying candle, and of course we got the ascending kind of channel. Now we've broken through 78. So you've got to think that short term, it looks like oil wants 82 barrel. And that's going to be a pretty important point. To just detail how important this drop was, you'll notice here that we had the previous high, this high, and then of course we respected this in the direction of trend, came down, and then tried to short, probably trapped a bunch of people into shorts here because it became a bit obvious. And now we're pushing towards that 82 a barrel. So you'd have to think that probably rips down in oil, at least temporarily, we met by 82. Overall, we still believe 65 a barrel in 2023 is very possible due to basically demand destruction. Now, here's where the elephant hits the room. Did we just hit the perfect level for Tesla? Well, we've talked about the gap close, and here's where the gap was. So I'll actually put it perfectly on that, which gives us 135.94. So I'm going to read out the low of the last session, 135.89. That's damn close. Damn close. So it's hit the level, and we know that Tesla is putting in the good work trying to build a case, you would think, basically for maybe the shipments to improve. I mean, you wouldn't be offering 7,500 unless you're trying to stack pad Q1 earnings, yeah? This is also where we find some options and some interesting levels. So we've come down. This is an aggressive short. Is it capitulation? Well, you would have to think that the 24 hours leading into the last session was pretty bad. That was over 8-9% from top to bottom of this switch, which we have been negative on Tesla throughout this time, 31.6%. But look, we always said this was the level, and it hit it. And even in the last 24 hours, I thought that maybe even the 137 around that area would be good. I guess it pays to be patient. Yeah, patient, react, don't predict. Look, we hit the level. Usually the way that you'll see markets is they'll kind of do this. And you'll actually get a lot of opportunity at these levels. If we're talking about where Friday wants to close, at the current report, it looks like 140 would be the action area. That's where you're seeing a lot of hedge offs in options at the moment. But look, 136 was hit. You have to think the markets are currently in a little bit of a rally town and that there is a huge amount of capitulation selling. Why can't it come up more though? Well, it's got to do with actually all of us, the retail traders. Look at them. Everybody's stacking into the buy side. And I think this has a lot to do with the poll. So generally people were saying, why is Tesla going down so much? Is it because Elon's running Twitter and this is becoming a disaster and all these things? Well, I think that's part of it. But then, of course, the poll was had saying he'd step down and people went, oh, that's super bullish. And it makes some logical sense, I guess. The market was capitulating. Tesla was going bad. But take a look at how many options were opened for the 23rd here in the last 24 hours. Lots of people going bullish and speculating on the 160, 175, 180 strikes, those ones there. It's a bit of a problem. Now, if we actually drive out and we go to, let's say, the 20th of January, you'll notice there's a huge amount of options here. I don't know who's got these 40 options, but anyway, 2,901, so 2.9 million units. And we've got here 200 calls, 166 puts, 100 puts, 120 puts, 150 puts. So we're not clear on exactly where the market should go, but there's a decent case to be said that maybe we're going to stabilize here based on the fact that we've still got a decent amount of puts sitting around 166. So keep looking at the January strike for Tesla and specifically see whether we get some puts starting to structure up in here. We know that probably the market doesn't want to be above 200 come that time, but we also know that it may not want to be under 160. So are we coming into a structural base formation? You'd have to start to think options are proving that that could be real. What about Apple? Does things look good? Well, this is in line with our strategy. The strategy was that we hit extreme demand, or we hit basically a big support. We've sold off aggressively. To put this in perspective, Apple sold from the top to the low about 13.3%. That's a lot for the biggest stock in the world. And then we've had a nice turnaround, and we probably expect a little bit of a rip. Let's have a look at the 2 hour here. So the market gap went down, gapped up, and it's doing a nice job of getting back in. Now, where is our previous gap? So we've left a gap here now, but we also have one that's sitting around this 143, which would be in line with the downward trend. Now, when we look at the S&P 500, it'll make more sense in a moment why that's a distinct possibility. But at the moment, Apple's doing okay. What about Apple versus the S&P 500? Well, the combo is right on the support. Again, I think in the future, we expect that to go worse. But for now, we can see why buyers are rebuying themselves. Amazon, what about this? Actually, it looks terrible. I mean, that is a shocking candle. But I could still see a buy, then a rip down later to 2020 lows. 81, a long-term target that I've had for Amazon. We'll find out whether it hits. I like both of these extreme lows. 65, imagine that. Woo, that'd probably be like a 3250 S&P 500 if that occurs. It is possible. You have to recognize that you didn't think this was possible. Well, it's about to happen. So, for now, maybe we're seeing a little bit of a rally, but there's still very, very real numbers down there. Microsoft, again, why are we bouncing? Microsoft hit a critical zone, one of the best stocks in the market, hitting critical. It's why we're allowed to bounce for now. Let's move over to the DAX. What's the DAX doing? Well, most beautifully, we got this amazing distribution. And the DAX has been nicely rallying. And I'm just going to give some stats here. Let's see if I can bring them up for you. So on the DAX, 61% of retail traders trading futures or CFDs are short. Well, they're getting ripped. And it's 74% for the FTSE. So if you look at the UK 100, it's also a hugely shorted in comparison to longed. And that's very interesting here. And again, which have been performing the best? Well, theoretically, the DAX did better numbers in the last couple of days than the US market did. So where do we find issues? Well, 14.2 is, of course, a very clear level. 14,200. We're not there yet. But you'd have to think the DAX wishes to go up to around that level. That's the previous supports. Over here, it's a great role reversal. Big problems potentially in there. Even upwards of the 14.4, though, are very, very possible. And let's have a look at the S&P 500 to see what happens there. First up, Dow, the one that we used to show us that most likely a turn would occur. Again, very similar distribution, very similar problems for the long-term buyers. This is not the type of thing you want to see. And this is, again, a rally that you would have to think at this stage should be met by sell demand in the future. Again, Santa Claus rally. Let's find out whether it actually does happen. Because if it doesn't and the market goes up during the start of it, everyone thinks they're all great, and then it goes bad, we know the stats are bad for 2023, at least the beginning of it. This was the downward trend line. We broke it. We distributed. We're finding where we are right now. Let's have a look at the Dow smaller time frame here. You can see it's kind of hitting a relatively critical zone. Let's look at some other markets. We'll go over to the Nasdaq. It's been hit by realistically valuation concerns. Again, we have a very similar scenario of a massive, what looks like distribution. We're currently rallying up. We are coming into the problem zone. So there's a case to be made that profit target people will be looking between that 11,350, 11,400. There might be some struggles in there. And I would kind of suspect that the markets could do this, maybe spike it, come down, then rally through, and then drop later. That's a very real scenario. For bears, the first entrance points for them, it's pretty much coming up, if not around here. Let's look at the US 500. Now, there's a lot of lines on this chart, so bear with me. First up, we thought this zone would be hit, 3,800, 3,750. Buyers recommitted themselves. Everyone's freaking out about the Bank of Japan. Don't worry about the news for now. The news is more going to be packed in the future. Then we saw the rally that we've got so far. Now, where are we? We're approaching a very critical zone. We've got that 3,900, 3,910. 3,910, 3,910, buying. Suddenly it went underneath, structured, sold off. So where do we expect potential sellers to come in? It's within the next effectively 20 points, 10 to 20 points. If they do sell, this is an area where you expect the bears to take some control. If we rally through that, you have to expect at that point buyers to come in each time it dips and for us to move back to the gap fill, 39.95. Now, what do we have there? Well, we have previous daily closes coming off the CPI. We also have a 61.8 fib, and we also have an unfilled gap. It's a pretty stacked zone. On top of all of that, we have a 200 daily moving average. So it's 4 times stacked. That's pretty good. It's a round number. It's a very clear zone, and it will also convince a lot of people rallies are back on. So I think you've got to be very careful around this. Even the downward trend line hits it. It's a serious level. So 4,000, it's a big one, and we'll be watching it, of course, on this channel as much as we can. Let's move over to options, have a look at the options for the week ahead. What have we got going on here? Yeah, whatever. I mean, 390s, obviously, again, that's where the biggest calls are at this stage coming into Friday. Is that in line with what we just said? Maybe a market coming up, 39.10, struggling around there and then kind of moving down? Well, I guess you would say, yes, it is, because that's where the calls are. It's not guaranteed. Nothing is. This is only a very small amount of options in comparison to most of the time. But I do think we need to remember, even if you're feeling bearish on markets, go forward to the 20th of January. And we'll do this many times over. It's still stacked with puts everywhere. So we've got to remember the best thing for the market to do right now is stuff around, then move down and not pay any of these people off in January. And remember, that can be done by stuffing around, by basically pushing the market up, selling it off a little bit. I expect us to be unfortunately stuck in a range of, 4-5% on markets, maybe for the next little bit over the summer period. Now, it doesn't mean you can't watch the videos. Of course, you've got to watch the videos, guys. But it will mean that we have nice technical markets. There's nothing wrong with being in a range as long as you recognize those opportunities. And look, that's just what the statistics are telling us right now. Let's move over to Bitcoin. Does Bitcoin look long or short? It should have probably rallied here in the last 24 hours. I don't know what it's doing. It really should come down maybe a little bit, then rally up. I still like that 17.5 level for Bitcoin before finding maybe further shorting. It's been a hard market. A lot of people think it's been easy. I still think it's been a relatively hard market, and it doesn't really know what it wants to do. There's like traps inside. We knew 18,000 was going to be a big key level. I guess it was. It went a little bit higher than that. And then now we're finding ourselves with a bit of a reversal on our hands towards 17.5. So we like the idea of still short Bitcoin overall, but realistically, the stock market has to come with that. So what about the news? Well, we have core PCE price index. This is usually a pretty big bit of news. It comes out on 8:30 a.m. Friday, so definitely watch that one out. As always, follow us on Twitter, links in the description down below. And if you're interested, we've got a sale for Christmas as well, links in the description down below for our scalping masterclass. If you want to find out more about that, make sure to subscribe, make sure to smash that like button, and we'll see you in the next one. Thanks so much for watching. Bye for now.